Clothing stores look like some of the most profitable businesses in the world. A t-shirt that costs a few dollars to make sells for 40. Jeans sell for over 100. New collections arrive constantly. Stores are always busy, and yet most clothing retailers barely make any money. Many lose money outright. Even large, recognizable brands struggle to stay profitable for long. The contradiction isn't that clothes are cheap to produce. It's that selling a lot of clothes doesn't reliably produce profit. The tension sits at the core of the apparel business. Clothing combines fast-moving consumer tastes with slow, rigid production decisions. Inventory is ordered months in advance before demand is known. Once it arrives, it starts losing value immediately. The faster a retailer chases trends and volume, the more inventory risk it takes on. The more conservative it becomes, the faster it risks becoming irrelevant. Profit lives in a narrow band between speed and accuracy. Clothing matters because it hides fragile economics behind constant activity. Everyone buys apparel. Stores are everywhere. Sales signs never disappear. That visibility creates the illusion of strength. Underneath, the industry runs on thin margins, high fixed costs, and relentless markdown pressure. Small mistakes don't stay small for long. The economics begin long before items reach the rack. Most apparel is produced overseas with long lead times. Designs are finalized months ahead of a season. Retailers commit to quantities based on forecasts that are only partially informed. Fabric is ordered. Factory capacity is booked. Cash leaves the business early, long before customers signal what they want. Once production is locked in, flexibility vanishes. If a style works, it often can't be restocked quickly enough. If it misses, excess inventory floods stores and warehouses. Clothing ages poorly. Tastes shift. Seasons end. What doesn't sell early rarely sells later at full price. Inventory velocity becomes decisive. Velocity describes how quickly products sell relative to how much is stocked. In apparel, velocity is uneven. A small share of items drives most full-price sales. The rest linger. To clear them, retailers rely on markdowns. Promotions become routine. Customers learn to wait. Full-price selling shrinks each cycle. Returns compound the problem. Apparel has some of the highest return rates in retail, especially online. Sizes don't fit. Colors differ from photos. Preferences change after delivery. Returned items often can't be resold as new. They're discounted, redirected, or written off entirely. Each return erodes margin and adds handling cost. Physical stores intensify the pressure. Clothing retailers depend on large store networks for traffic and brand presence. Rent is fixed, staffing is fixed, visual merchandising and utilities continue regardless of sales. Inventory moves slowly through each location. Every unsold item occupies space that could have been used for something newer. E-commerce promised relief. It reduced reliance on stores and expanded reach. It also introduced new friction. Online sales raised return rates. Shipping and reverse logistics added cost. Customer acquisition became expensive. Price comparison became effortless, compressing margins further. The result is an industry that looks healthy on the surface and strained underneath. Gap Incorporated illustrates this clearly. Gap was once a dominant global retailer. Its brands were everywhere. Stores filled malls and city centers. Scale reduced unit costs and ensured visibility. Revenue was enormous. Scale didn't remove risk, it magnified it. Gap relied on forecasting trends far in advance and pushing those styles across thousands of stores. Inventory commitments were made early. When products landed, the outcome was already determined. Strong demand still faced replenishment delays. Weak demand created immediate excess. The inflection point came as consumer preferences shifted faster than Gap's production cycle could adapt. Styles missed. Inventory aged. Promotions increased to clear shelves. Gross margins fell. Revenue stayed high, but profitability weakened. To compensate, promotions expanded and assortments widened. Stores stayed busy, but customers were trained to expect discounts. Full price selling declined further. Inventory discipline eroded. Each season began with more product and ended with deeper markdowns. Fixed costs didn't adjust. Store leases locked the company into expensive locations. Closing underperforming stores took time and capital. Online growth supported sales, but increased returns and logistics expense. The company didn't struggle because people stopped buying clothes. It struggled because its operating model couldn't respond fast enough to change. Scale reduced flexibility. Decisions made months earlier dictated present outcomes. This pattern repeats across apparel. Fast fashion shortens cycles but increases volume risk. Traditional retailers slow cycles but lose relevance. Online brands cut storefront costs but absorb returns and marketing expense. Each model shifts risk rather than eliminating it. The broader lesson extends beyond clothing. Businesses with rapid demand shifts, long production commitments, and high fixed costs are structurally fragile. Visible sales do not equal economic strength. Growth can hide imbalance. Revenue can rise while profitability deteriorates. Clothing stores don't struggle because customers disappear. They struggle because fashion is unpredictable, inventory is unforgiving, and costs don't flex easily. Profit depends less on how much is sold and more on how little goes wrong. That's why so many clothing retailers appear successful right up until they aren't. The stores are full, the sales signs are everywhere, and the margins are already gone.